In this week's video, we'll review the latest charts, data sets, and studies to help us understand why the fragile stock market is still susceptible to painful downside. We'll be moving quickly, so feel free to use the pause button on your video player. Let's kick things off by reminding ourselves historically, how bad can things get in the stock market? Let's assume we had $1 million invested on January 3rd of 2022 when the S&P 500 peaked. If we experienced a drawdown similar to what occurred in 1916, our $1 million would be worth approximately $598,000. 1901, 1919, 1909, 1906, 1973, that drawdown would take our $1 million hypothetically down to about $500,000. The year 2000, just under $500,000. 2007, now we're getting near $400,000 in terms of what's left after the drawdown. 1937, approximately $400,000. And the big one, 1929, the Dow Jones Industrial Average lost approximately 90% of its value, taking $1 million hypothetically down to approximately $108,000. The 1929 case is the worst case out of the cases that we've covered from a magnitude perspective. In terms of duration, the 1937 case took 1,875 calendar days. Thus, hypothetically, under a worst case scenario, that $108,000, the bottom might hypothetically arrive if we peaked in January of this year, in February of the year 2027. This helps us understand all of that from a dollars perspective. How about a visual perspective in the market? So the S&P 500 peaked in January of this year. If we had a drawdown similar to what occurred in 1990, we'd come down to this level. 1998 down to this level. 1961, 1980, 1946. 1987, 1968, 1916. There's a whole cluster of drawdowns here. This is the year 2000 case. Here's your hypothetical low if this was your hypothetical high. 2007 case, you come down hypothetically to this line here. And once again, the granddaddy of them all, 1929, unbelievably, the S&P 500 hypothetically would go back to levels seen in 1995. From a historical perspective, obviously, this is the bad news. But since the S&P 500 made a new all-time high earlier this year, we know in every single case, once a low was in place, good things eventually happened. In fact, the average gain in the stock market 1 year after these periods, 51.2%. The median gain, 42%. Now let's review numerous reference points in the 2022 market to see what we can learn. This is Dow up-down volume after the huge rally following the Fed press conference. It looked like the market was trying to retake these key levels here. The McClellan oscillator also was rising and above the zero line. If you follow the markets closely, we know this turned out to be another one-day wonder, and those gains, for the most part, all of them were given back, and we're still near this inflection point area on the chart of up-down volume for the Dow Jones Industrial Average. Similar situation, up-down volume for the S&P 500. Here's your inflection point. Here, a noteworthy divergence that may or may not come into play next week. The Dow Jones Industrial Average, obviously made up of industrial stocks. This is the much broader Dow Jones Composite. Support, 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 support in this general area. Breached it earlier this year, so this was a reference point here. On Monday of this week, we had a big drawdown here, and then it looked like we were going to hold in an extremely important area. And at the end of the week, we're basically right in this area here. Charts down here. Here's the close. Thus, on all of these charts, we can draw the horizontal lines and hit price going back almost a year here. But if we move into this area here, that's not the case anymore. and support or possible support below in many of these cases starts to get a little bit more flimsy if we do drop out of the range. Economically sensitive travel and tourism weekly in a very vulnerable looking but still holding spot right here where my cursor is. You can see the 200-week moving average is flattening out and possibly rolling over. You can see here, big rally. Here we held and rallied. Now we're sitting in the same basic area where we bounced before. Similar situation here with IGV, a software ETF. It held near the 200-week moving average in 2016, S&P 500 here. Held here in 2020, S&P 500 here. Back in the same general area, trying to get a nice weekly bounce. After the Fed meeting on May 4th, ETF was up at that point 4.12% for the week. If we fast forward to the end of the week, this is the close on May 6th, you can see we've got that inflection point look as well here. We'll learn something either way. Historically, this ETF, back to 2016, has tended to bounce in this general area. Not making any assumptions in the present day. Dow Jones Industrial still in the range at the end of the week. In terms of leadership, the Dow trying to break out relative to the NASDAQ. It's a monthly chart of foreign stocks that we've covered in the past, has a vulnerable rollover look, but it's still hanging around this possible inflection point line here as well. NASDAQ 100 over here after the Fed rally on Wednesday, looking like it's trying to hold these general areas here. Fast forward to the end of the week, much more vulnerable look here. Some possible support over here, but vulnerable or very vulnerable would be the word here. A lot more vulnerable right here than it was in this area here. NYSE Composite, this would be our retest level here. So this was the intraday low in February. We basically closed on that line on May 6th. And since human beings like to extrapolate, most of us would look at this chart and say, for the most part, we're getting range expansion here. And that must mean that we're going to roll over. And at face value, that is very logical, and that may be what's happening. However, you can make the same argument up here. This is range expansion up here. You can see the range was back here. We broke out. And here you can say, see this white space here? See this high here and this high here? We must be getting stronger than we were over here. And thus, if we extrapolate, we know what's going to happen. We're going to move in this direction here. But we all know that's not what happened. Thus, we'll wait and see what happens here relative to these areas of possible support. If you look at the same chart on a closing basis, May 6th, very vulnerable, meaning from a risk management perspective, the market and a lot of these charts have little to no rope. If we can't hold levels like this on these charts, under our approach, we'll be moving away from risk at a more rapid rate. A similar look here on this weekly chart. You can see we closed right here, very, very similar to this level here. The markets are vulnerable. This is not a good look. A chart like this and a chart like this as of May 6th is one of the reasons why at the end of the week we have more cash than we did at the end of last week. We have been seeing some whipsaws on a lot of these charts. You can see it here. It looks like a breakdown. Then it looks like we're getting back in. We have a failed breakdown look, and now we're back below. Look how many times we can hit price in here. This is all possible support. Where we are now, we can only hit it right here. So just as this chart went up rapidly over here, it's more vulnerable to falling rapidly in this area here. That's not a prediction in any shape, form, or fashion. Here's a box that we covered last week and maybe the week before. You can see the S&P 500 came down to the bottom of the box and at least for now is holding. There's a gap here at 40.20. It's just good to know. There's nothing magical about that. Here's the trend line that we talked about last week. We're still holding above it. If we extend it down here, we still held above this 41.14 level as of the close on May 6th, but we're very, very close to it at 41.23. From a risk-reward perspective and a support perspective, very, very small margin of error down here, but you could have said the same thing in this area here, and we did rally. Equal weight S&P 500 on Monday, it looked like we were going to break out of the range. Then we popped back in, and now we're testing the bottom of the range again. Here's where price is here. We can hit it here, 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 and here. That's not the case if we get into this area here. Another very, very volatile week for really everything, including the VIX. The S&P 500 was up, it was down. It ended up, for the most part, flattish for the week. And after a lot of wild swings, the VIX ended up down approximately 10% for the week. Another vulnerable-looking chart, little bit of a cluster of possible support here, but this looks quite a bit worse than it did here. Similar situation, you can read about these indices here at the bottom of the screen. This level here goes all the way back to 2018. We closed below it this week. You can see it here. Went up very, very rapidly. It's telling us if we can't make a stand very, very soon, maybe in this area here, something similar like this could happen, but it could be a mirror image. Not a prediction. Just speaks to probabilities and the way support tends to work. On the other end of the spectrum, natural resources trying to break above long-term resistance dating all the way back to 2007. Like many of those other charts, this is an attempted breakout. The longer it stays above these areas here, the more meaningful it becomes. But this is still in process, just as you could say this is an attempted breakdown. Similar concepts here, S&P 100 large cap index. Amazon relative to the S&P 500. Here's the big run up here in 2020 during the COVID scare. We've come all the way back to that gap, and now we've closed below this gap. In some instances, gold can act as a defensive instrument. Right now, it looks like it's trying to turn up relative to the S&P 500. This is a good look in here, but here it's tepid still. Really need to see this get out here to get more confident. You can see why this ratio is more vulnerable if we drop below these lines. In terms of breakdowns, have a lot of breakdowns in the area of growth, a lot of breakdowns relative to small caps. And if we looked at a chart of the triple Qs relative to the S&P 500, we would be down in this area here. And that's all reflected in the positions that we hold today and the positions that we no longer hold. LQD earlier in the week was green for the week. It finished red. This is not a good look. You're seeing here a lot of similar looks. Very, very vulnerable in here. Defensive SP low volatility, multiple month breakout relative to SPY. Here's your base. About the only good thing we can say about this chart is the ratio didn't exceed this high at the end of the week. That leaves the door open for a chart like this, and a chart like this possibly making a stand next week. And the fact that the VIX was down roughly 10% this week also leaves a small crack in that probability door. We've reviewed this chart many times. What it's basically telling us is what we're used to in the markets, there could be significant shifts in subsequent years. Make an argument, this is your left shoulder, this is your head, this is your right shoulder. We have a breakout above the neckline, XLP relative to XLK. Once again, about the only good thing you can say, it didn't exceed this high this week. And in terms of tech ETFs, remember we said the triple Qs relative to the S&P 500 had a clear breakdown. A lot of growth ETFs have clear breakdowns versus the S&P 500. That's not the case for XLK. Still holding up relatively well and still in a range for the most part. Let's check in on some of our probabilistic lines in the sand. This is the NASDAQ composite relative to the average and median drawdown. This is after the big Fed rally on Wednesday, looking like it's trying to hang in there and make a stand. Here's what we looked like at the end of the week. Study that we completed last year after the S&P 500 finished a 5-month win streak at the end of June. This would be the average and median drawdown in those historical cases, and this is where we closed on Friday, May 6th, right on the orange line. Here's the look at the 7-month win streak. Hypothetical drawdowns looking out 12 months. Vulnerable would be the word here. This was based on the rate of change in a corporate bond study that we completed recently. Looking a little bit better on the American Association of Individual Investors study from April 28th. Still holding this area here. If we can't hold it relative to these studies, it gets a lot more concerning. As always, none of this predicts anything. It helps us assess the probability of good things happening relative to the probability of bad things happening. And keep in mind, on all these charts, this was the maximum drawdown here in one of the historical cases, a maximum drawdown here, and the average of the two, meaning this was the low in those historical cases. In September of last year, we did a study based on similar trends, trying to make a stand at the lower end of the range. Very, very similar concepts relative to a recent study based on MS World. The rare 2-day swing study that we recently covered, if you can't make a stand soon up here relative to these historical cases, historically starts to get quite a bit more dicey with your average and median outcome down here. You may remember from last week, this was the back of the envelope aggregate calculations that we did using multiple studies. The purpose here was to say the more shallow drawdown cases are here, including this one. It's here because in terms of calendar days, it happened relatively quickly. If we can't hold these levels here in terms of these studies, it would open up the door historically and probabilistically to significantly lower levels. For now, we're trying to hang in here near this blue line. Similar situation here. Here are the levels that we've talked about, kind of typical and historical drawdowns in the S&P 500. We're still in that general area, but not a lot of room below here. Let's see what we can learn relative to the worst start to a year in S&P 500 history. Source of everything on your screen right here. Here's the Twitter handle here where my cursor is. 2022 goes into the books as the worst start to a calendar year through April's close in the S&P 500's history. Or on the left side of the screen, here's what the rest of the year looked like when the S&P 500 ends the month of April down 5% or worse year to date. We focus over here. The maximum 12-month drawdown would say, for the most part, if this were going to happen, liquidate everything. However, we're near inflection points in the present day, and you can see the maximum 12-month draw up. The gains also very large. The average, 13.9%. And hypothetically, that would mean, on average, the market moved at some point over the next 12 months 13.9% above the close at the end of April. Also noteworthy, it's very, very possible that these draw-ups occur on the other side of the drawdown. So if we take this data here from this source again, some things jump off the page. Here, 1 month out, not a lot happened. This is the return in the S&P 500. 2 months out, not really that painful. 3 months out, the S&P 500, the median outcome was a decline of 1.32%. But this is where it changes. Somewhere between 3 months and 6 months is where you tend to get your largest drawdowns. And then after that, it starts to become a little bit more muted relative to returns. So this is returns, 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 returns. This is the maximum drawdown here. You can see these are very, very painful numbers that do seem to align with an inflection point look. This says we could get a big rally at the inflection point relative to these historical cases, and this says we could get a really, really big drawdown as well. Since we know where the S&P 500 closed at the end of April in 2022, we can take the average and median outcome, put it on a 2022 chart, and it tells us that risk management, at least from an odds perspective, should be very, very high on our priority list. Additional risk management, the possibility of raising additional cash in addition to what we already have. And in terms of the path, this is the maximum, this is the median and average drawdown in the historical cases looking out 12 months. The returns from the end of April 2 months out, here's the average and median return, tell us it doesn't necessarily mean things, even if really bad things happen, that they're going to happen in the next 60 days. Again, historically, they tended to happen somewhere between the 3 and 6 month window, with things being a little more muted for 1 to 3 months. And once again, this is the bad news. This is definitely glass half empty or empty. It's important to understand that in every single case, good things did happen on the other side. From the low, the average gain a year later, 31%, the median gain almost 36%. And even in this case here in 1975, if we say that this is point B, the additional rally after a year from B to C was 61.27%. The market was higher, significantly higher in 1980 from this point here. And if you know your stock market history, September 21st, 2002, not a good look here, but you're very, very close to a major low that occurs approximately within the next 4 weeks. There's a major low that occurs in the S&P 500 in 2002 in October, and from that low, the S&P 500 rallies all the way until it peaks in October, early October to mid-October of 2007. So relative to these inflection point looks that we have as of the close on May 6th, this 13.9% figure and this 6.52% figure tells us it's possible the next move is up, not down. But if it breaks the other way, this column and these figures here and this average and median outcome here tells us that's why we call it an inflection point. And thus, we'll continue to pay attention extremely closely, and we will continue to be ready to take additional defensive action if needed. And remember the back of the envelope calculations last week from some other studies. In these big drawdown cases, so say the market fell an additional 20% from where we are roughly today, in those cases that we studied last week, you had 146 calendar days before you hit this low. The median outcome, 160 calendar days. That would put the low somewhere in September, meaning we don't really have to overreact in terms of history to see what happens near some of these inflection points. And in these cases, where the drawdowns were relatively muted or short in duration, the S&P 500 made a stand somewhere in the 4163 to 4141 area. We closed on May 6th at 4123. Obviously, this outcome and this outcome significantly different from this one and this one. Obviously, in the markets, a what to watch segment could be 6 hours long every single week. But keep in mind this topic that we covered a few weeks ago. We've got a CPI number coming this week, and obviously that's going to be extremely important to everything that we're talking about this week. Things have been extremely volatile, a lot of whipsaws, a lot of head fakes. This is total market advance decline line going back to 1996. Look where we were here as of Wednesday, May 4th, way up here. Big gains in the markets after the Fed press conference. The following day, the polar opposite and noteworthy. See where the level was here as of the close on May 5th? The only other time we've been down there is right here in the spring of the year 2000. This is the S&P 500 here. And obviously, this is not a perfect way to look at this because the number of issues changes over time, but it is being balanced out by the fact that we're taking advancing minus declining issues, and this is a very, very rare reading, as this reading was here in the year 2000. It's going to be very, very difficult for these inflection point situations to resolve themselves in a bullish manner unless one of two things happens. The 10-year yield, which is basically the benchmark for all interest rates in the U.S. economy, has to calm down or stabilize. Hasn't happened yet. As of May 6th, still rising. That is a major headwind for the market. And number two would be, and they're basically the same topic, if we saw significant changes relative to the inflation data that we have coming in subsequent days and weeks. You can pause your video player here. This speaks to odds and asset class leadership. This is Microsoft Tech relative to Exxon Energy quarterly. This is the year 2000 where my cursor is. This is the present day here. This is momentum in the present day. This is momentum back in the year 2000. Not a prediction in any shape, form, or fashion, but it's relevant. If the inflection points are going to resolve in a bearish manner, you would think that your leaders, value stocks, utilities, healthcare, materials, commodity-related issues, you would think that some or all of them would start to break down. You can see VTV is holding up fairly well here, but it's sitting right around the 200-day moving average. If it were to move into this area here and stay there, that would increase the probability of resolutions on all these charts to the downside. Right now, it aligns with the try to be patient and see what happens next. Even if really bad things are going to happen over the next, let's say, 6 months, it doesn't mean they're going to be bad in the next 60 to 90 days. XLK relative to XLE has been hanging around this area for 1, 2, 3, 4, 5, 6, 7, 8 weeks. Here's the COVID gap up here that we've covered on the weekly chart before. Closed well below it this week. Also, momentum down here, RSI, ended the week below 30 again. This speaks to the odds of XLK underperforming XLE. This is the first time we've had a weekly close below this level. There's another chart saying some patients may be in order. For the full week, XLP underperformed SPY by a full percent. So we have to keep in mind this look here in the S&P 500, this look here, and this look here. We also have to keep in mind it's possible we're going to go back up to this level here before we see something like that or that. We don't have to know what's going to happen next for this to be useful. Right now, we're above the 200-week moving average. It's flattening out, and this is also relevant. XLP underperformed SPY this week, while the stock market tended to be weak. Covered this concept last week. This is a look as of May 6th. It's basically telling us it's possible the market is not oversold yet, and we could have significant downside until some of these indicators get into levels where bottoms were found in the past. Everything we said about the last chart applies to this chart, and I believe we covered this chart last week as well. This just gives you a look as of May 6th. It's the S&P 500 on the bottom. The fact that the S&P 500 has dropped in a significant manner this year is telling us that recession probabilities are increasing, and we are starting to see some weaker economic data, or at least mixed economic data. Here are the charts we covered back in April. We've got that similar inflection point look here in the present day. You can make an argument it's similar to this area here and similar to this area in here. Haven't really moved away from some of these levels yet. But again, we don't have much room left. If things get worse, it doesn't necessarily mean they're going to get worse in 2 or 3 days. It could take some time. Here are the shorter duration drawdowns from the envelope calculations on a 2022 chart. And we're basically in this area here still, telling us some patients may be in order. And if something like this happens, our goal is to significantly mitigate the additional drawdown that we might experience relative to the markets. Because we know at some point Just as there was in these midterm cases here that we've covered in the past, LPL research, after these lows, the S&P 500 gained approximately 33% in the subsequent 12 months, telling us to keep an open mind about better than expected outcomes on the other side. Same situation relative to the hypothetical drawdowns that we covered earlier in the video. In every case, the other side looked a lot better. Inflection point tells us we should be ready for bullish outcomes in the short to intermediate term, and it tells us we should be ready for significant additional downside. Order of magnitude of 10 to 20% of additional downside is well within historical norms, not a prediction. The inflection also tells us that a sharp rally scenario is still alive and well in the short run. If we get a bearish break, capital preservation has been important. It will ramp up even more because the risk will be higher if we lose support. Big report coming Wednesday. Until something changes, these are going to be a problem until proven otherwise. If we clear some type of less bad hurdle relative to this, or this, things can change very quickly. In terms of support and everything in the markets, nothing is binary. If you break support, it doesn't mean that's a permanent condition. The longer the break remains, the more relevant it becomes. There's a reason why we always use this expression. Everything that we've talked about in this week's video is based on what we know today. And that was true 6 months ago, 24 months ago. How does that apply today? 24 months ago, we really didn't think inflation was going to be a significant and lasting problem. Things have changed. The charts have changed. The term odds, significantly different from certainty. It's always important, but maybe more than ever, to be very flexible and very nimble. Make no assumptions about what's going to happen next. Make no assumptions about how long the market's going to fall. Make no assumptions about when the low will be in place. No extrapolation and no forecasting. And we all know the only way any of this works. So we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.